Yo, I'm Brendan, and this month I got financially throat punched by the stock market. I'm going to tell you all of what happened and why. I basically fell for a trap that you need to not fall for, and people actually warned me of this, so I should have known better, and on my own, I also should have known better. But this trap that I fell for is highly appealing, so you might be falling for it right now. I want to go over it with you so that you don't fall for it. I'll also share with you my dividend investing results from the month of January of this year. Pretty exciting stuff. I made pretty much the most money I've ever made, second to the most money I've ever made, which is really exciting. I like making cash dividends. I think it's really fun, even though I just have them all set to reinvest. So let's get into it. First, let me tell you about the trap that I fell for. My confession is that I invested in an individual stock that was a medical related stock that had a great dividend. And I thought that was pretty much all I needed to know. They kind of are the landlord for different medical companies, like hospitals and different medical offices and things like that. And I thought, hey man, there's big margins there. There's high cost. People are paying a bunch of money to go see the doctor. People are always going to need to go see the doctor. So why not invest in this? Granted, I don't have like $1 million invested with them. I think I have like, I don't know, a couple $100 invested with them. It's not make or break for me. But if I did, it would be make or break, because the reality is they dropped like 30% in a day. This stock got absolutely crushed. The stock is called MPW, Medical Properties Trust. And if you read stock market news, you've probably heard about them. It was an absolute slaughter. Wow, look at this chart of MPW stock just plummeting over the last year. So a year ago, last February, it was at $13 a share. Starts going down, plummets pretty hard into the early spring. Then in the summer, it rallies a little bit. It's up there in July at $10 a share. It's doing okay. I forget exactly when I started buying it, but it was somewhere probably around that time. I think it was like $7 or $6 a share. So I'm probably buying it right in here around like September, and then just watch it continue to plummet, $5 a share, $5 a share. And then here in January, boom, falls off a cliff, $3 a share. I mean, to go from 5 to 3, we're talking like a 35% drop right there. That is nuts. And then now as today, it sits at 326. I mean, what a fall from grace to go from 13 to 3 in a year. That is not good. I'll show you a couple of different sections of Seeking Alpha articles as I look up this stock. A few different people have written about it because it's a pretty juicy story. And those of us who are invested in it have taken a pretty big hit. The first line of this summary of this article says, using dividend yield as a starting point for stock analysis is a mistake that can lead to poor returns. You're not wrong, buddy. Corey Kramer, who wrote this article, I believe you now. And I think he's probably right in his assumption here that the popularity of dividend investing has caused stocks with high dividend yields to be overpriced. A lot of us are underanalyzing a company when it comes to picking what we're investing in. So we look at something and we go, it's got a high dividend yield, the price has been going up, looks good to me, let's just go for it. In reality, there's a lot more research we could be doing there. We could look at the kind of companies that are making up this stock. We could look at what their portfolio looks like, what their financials look like to say, looks like maybe they're in trouble. Maybe they haven't been getting rent for a while from this one company. Maybe that's a bad sign. Despite what the price is doing, despite what the popularity is, maybe there's an underlying thing here that's not so hot. That's exactly what happened here with this stock. Here's a little quick description of what MPW does. So Medical Properties Trust is based in Alabama, and it's a real estate investment trust. You've probably heard this term before if you're an investing nerd like I am. A REIT, real estate investing trust. So it's a bunch of different people, potentially, or a lot of different money has come together to invest specifically in real estate. So in physical buildings, specifically for healthcare facilities. And I think that's pretty self-explanatory, but this next line isn't subject to NNN leases. What that means is triple net leases. So these are the kind of leases that you set up with a business that say, basically, as me, the landlord figure, I'm not doing any of the maintenance. I'm not doing any of the boots on the ground work. All I'm doing is collecting a check. Okay? The company owns 438 properties, which is a lot. That sounds pretty diversified, right? Like these people have a lot of different companies and properties that they're managing all across the world. It seems like good idea, good business. The problem is that when Stewart Healthcare System, SHCS, who is MPW's largest tenant, stopped paying rent, people noticed. And people said, maybe MPW is in financial trouble. We're talking about 23% of their total revenue. That is crazy. So 23% of this whole stock company, this REIT's revenue, came from this one group. They are the group who can't pay rent. Oh my gosh. So of course, what this Stewart company has been telling everyone is they're hiring people to help them figure this out, help them how to figure out how to pay rent, help them kind of bounce back from this. But in the meantime, we all know that the real estate investing trust is going to be hurting for the rent. Maybe they'll never get this rent back. And how can somebody like this pay a dividend if they don't have the cash? If they're losing 23% of their revenue, where are they going to get that cash from to pay a dividend? So a lot of us who held the stock said, sayonara, we're out of here because we're not going to lose out on this dividend that we want. We're leaving. And when that many people leave, the stock price plummets. It says here in this article, the current distribution, the current dividend at 60 cents per share means an 18.3% dividend. There's basically no way they're going to be able to pay this. I mean, if they continue to pay it, I don't know how they can do that as a business. I mean, maybe there's a way I don't understand, but it just seems like if you don't have that cash flow, then if you still find a way to pay the dividend, you're probably just bleeding yourself out even more. And so that would be even yet another bad sign for this company. Then it says later on here in the article that MPW has hinted that the SHCS, which is that company that can't pay them, their impairment should not affect their ability to maintain the reduced dividend, with the operator contributing $67 million, around 11 cents per share. And the extra funny thing about this whole deal is that it was brought to light that much more because I had somebody comment on my previous dividend update video that said, hey, Brendan, what would happen if you invested $5 per day? They were just curious. I'm guessing that that's kind of their budget and their expectation for what they might want to invest, and they want to see what their results are. And so I went into Robinhood and I set up an automatic $5 per day investment into medical properties trusts. Of course, I pick MPW not knowing that just a few days later, the thing was going to plummet. And so here I am investing $5 per day. I'm getting this little notification. Hey, you've bought however percentage of a share. Great. Then the next day I get another notification and it's like, you bought a whole share. I was like, wait a minute. I was getting part of a share before, and now I'm getting like more than one share. There's only one way that happens if I'm still only investing the same $5 a day. This thing must have plummeted in value. And I look and the chart's just falling off a cliff. And I'm like, oh no. The value of this thing has just plummeted. So thank you, loyal subscriber, for asking the question, for helping me figure out this experiment, because it ended up being way more interesting than I thought. And basically what happened is over here in this top left corner of my chart, I'll zoom in for you so you can see, I had bought $65 worth of MPW by the time it totally crashed. And I was like, we got to get out of here. This isn't worth it. What is that? 11 or 13 days worth of $5 per day. Then the rest of the time I switched it over and bought $5 per day in JEPI, which is another infamous, famous, popular dividend investment that you can make. And so we had 23 business days in January, which means I should have invested a total of $115 here. But you notice I only had $105 invested. I'm guessing whenever I switched and canceled the MPW order into an everyday JEPI order, that it must have just like lagged a day or two and then got going. I don't know. For some reason, I didn't quite get all the $5 per day, but that's what ended up happening with that. And you might notice this big fat $18,372, this transfer from what was really December of last year. I actually put it in my spreadsheet here in January because even though technically it did happen in December, those shares didn't have a chance to accept a dividend until now. And so I put it in here as basically a transfer that happened now, because had I totaled that up for my dividend calculation for December, it would have thrown that off and it would have made it look like my December returns were really small, but I had just transferred the money in there. And so it didn't go into effect yet. Now that it had actually been in there for the rest of December and in there for the start of January, it's a little bit more representative of the actual total that I have invested. It still probably skews it down a little bit because not every dividend probably had a chance to register on there and be in effect essentially for the transfer that I made, but it's getting closer. So that's why you see this big 18,372 up here, because it's there now. So that means that the total that I've invested to date in my life in dividend investing stocks, basically over the last year, we're almost at a 1-year anniversary of this, is $28,702. So Brendan, you might be asking, how much money does it give you if you have $28,702 in your dividend portfolio? Well, it's going to vary every month, But here's what January looked like, and here's what we got. The biggest payers were some of the ones that I transferred in. So $33 from JEPI, $51 from SPHD, then everything else was just a few bucks here and there. So the total for the month was $61.89. Enough for burritos, not enough for burritos and race cars, so it's not that exciting yet. This month's return in and of itself was 0.22%. And then based on having this much invested, this 28,702, if I got this same $61 every month and it never went up, then that would mean my total return in a yearly form would only be 2.59%. So to me, that tells me that the transfer has still not fully kicked in. It's not all the way there yet because I should be realizing a much bigger return than that. And so what I'm expecting too is that the next few months, I'm going to get a lot more dividends than that. But if we take each individual month and we average it out, then I'm still averaging 7.58%, even with this little month in there. So still pretty great dividend returns overall. 7.58% is nothing to sneeze at, I would say. But if you want to make serious money, you've got to invest more or you've got to invest longer. So that's the plan going forward. I'm going to go ahead and keep investing $5 per day for a little bit here. And I'm excited because I'm expecting that next month, March and even April are probably going to be my best months yet because I have the most money invested. And so that's going to be really fun to see the actual dividend amount that I get crest over $100 a month. That's kind of a fun milestone for me. Oh, and the really exciting thing is in February, we'll officially hit a 1-year anniversary of dividend investing. So that's going to be a fun video to make because I'll go over everything that happened in the last year and show you kind of what that journey was of starting with $700, working all the way up to now, knocking on the door of 30,000 and seeing how much different the dividends got. So that's pretty sexy. Maybe sexy is not the right term, but it feels sexy. And it's tricky because part of me is like, all right, well, where do we go from here? If the company recovers, if they can get this guy replaced, maybe they kick him out and get somebody else in there in terms of a renter. Maybe they are able to help them get back on their feet. They're paying full price rent again. Everything is good. Then it's actually a great time to be buying into this company because this is when the price is cheap, right? It's like we should be fearful when others are greedy and greedy when others are fearful. Well, everyone's really fearful of them right now. So if we believe that they're not going to go out of business, maybe it's a good time to be buying them. It's just this whole counterintuitive thing with stock picking in the stock market. It just seems so backwards. I stopped buying them because of all this turmoil, but maybe that was when I should be starting to buy them. Maybe I should transfer over $1,000 and put it into there because how much lower can they go, right? Unless they go out of business, in which case now I've just thrown that money away. So it's just such a tricky thing, this whole individual stock picking thing. I feel like my takeaway of this whole thing is probably honestly just to go, I'm going to stick to ETFs that have a bunch of different dividend paying companies in them. And yeah, I'm not going to get crazy returns. I'm not going to get a 12% dividend yield, but maybe there's a good reason for that. Maybe somebody with a 12% dividend yield is a red flag. I don't know. I think it's one of those tricky things where my mantra with long-term stock market investing has always been, look, you've either got to commit your life to doing the research on a company and understand all the underlying things like how well are their renters paying them money or not before you decide to invest in them, or you do the total flip side and go, I'm going to spend no time researching and all I'm going to do is stick to the tried and true path of index funds, dollar cost averaging, low fees, maximize my taxes in a retirement account, like the basics. And the problem is that I was kind of in the middle there. I was way closer to still the basics than I was doing tons of research, but did a little bit of research, read some articles, did some things, and it still had this big misstep. So what do we take away from this? What do we learn? I think we learned that you win some, you lose some, that individual stock picking is risky, that maybe you win big for a while, but you're also bound to lose big in some ways. And also maybe that reverse psychology thing of wow, they're doing really badly, I should buy some. That could really pay off for some people. I'm sure somebody right now is shoveling money into this stock and maybe it'll pay off well for them. I don't know. I'm also maybe not hungry enough to risk that much, if that makes sense. Part of my foundational rules of thumb when it comes to people and money and what we should do with it is, does it help you sleep at night? Can I rest easy knowing that I've done X, Y, and Z with my money? If for you, you feel reassured that you've taken that risk because you know what? You came out swinging, you did everything you could, you bet big on MPW when it was down, and you would be bummed if you hadn't taken the chance. By all means, do your thing, man. Invest in this stuff. But for me, I think I would be worrying about the opportunity risk of that money and going, I don't know, what if I lose it? If I lose it, I'll be so sad I didn't invest it safely somewhere else. I would rather have a less sexy guaranteed thing or more reliable thing than a chance at a risky thing. You ever watch that show Cash Cab? It reminds me of Cash Cab, where somebody in New York jumps in this cab. They think it's a normal cab. They don't realize they're on a game show. They get driven through the city. The guy asks them questions. They win some prize money. And then right before they get out, he goes, all right, double or nothing for one more question. So let's say they've made $1,000. They can get out, pull $1,000 cash with them, have a great day. Or if they want to bet it all on one more question, they can either double their money and go for $2,000 if they get it right, or if they get it wrong, they get nothing. And so it's like, it depends on your perspective on life. You know, it's like different people I'd watch the show with, they would be like, oh, I'd go for double or nothing on every time. Because worst case scenario, you got a free cab ride. That's a great day. And then best case scenario, you double your money, you got $2,000. Like, how wonderful is that? So for them, it was like the real opportunity is going double or nothing. That was like one of my friends. And for me, it was always like, no way, man. Now, if I lost that prize money, it would feel like a loss to me. And they kind of viewed it as, well, it still wasn't yours yet. So it's not a loss. I think it kind of feels like that here. The stock market is a much more serious thing than a cash cab game show from the early 2000s, but that's my analogy of the night. Oh, in other news, I had something exciting happen. I have an online class, and I've had 100 people take it on Udemy, which is the course hosting platform where it is. And I've gotten several new 5-star reviews. So my average is like 4.72 stars, which is pretty darn good average. Haven't made very much money doing it. Under $1,000 I've made with this whole thing. And it cost me 400 hours of my life to make it. So I'm averaging, pennies per hour. But my goal with it is to help people understand the stock market better, the basics of the stock market, not stock picking, not picking the best dividend investing thing, just basics of the stock market, how to think about it, how to pick the right account for you and get going. Because that's going to be the core, the big nest egg for most of us in terms of how we build our wealth. We don't have pensions. Most of us don't have a company that's going to take care of us in retirement. We got to take care of ourselves. So this course is about that. If you want to check it out, go for it. If you don't, no harm, no foul. I don't care. But I'm glad that people are taking the course and enjoying it. I like a good review. The secret comment word for tonight is cab, like cab that you take a ride in, because we just talked about that as a goofy analogy. If you like the video or you want to remind me what your opinion is on cash cab and what you would have done in that situation, then leave me a comment with cab in it. And otherwise, here's a video that YouTube thinks you will enjoy next. All right, see you guys next time. Bye.